Join over 5,000 attendees for the largest AI event in Asia at Super AI Singapore, June 5th and 6th, 2024. Raoul Pal, Benedict Evans, Balaji Srinivasan, Edward Snowden, and over 150 others will join the industry's most influential to explore and unveil the next wave of transformative AI technologies. Singapore will become a vibrant AI hub for a week from June 3rd through June 9th, with over 150 side events that will make for unparalleled networking opportunities. Visit www.realvision.com/superai for 20% off tickets with the code REALVISION or click below. Okay, let's start that again. Is this the longest week? Hey, everybody. How long's the Fed on hold? And welcome to the Real Vision Daily Briefing. With me today is Darius Dale, founder of 42 Macro. So if you're listening and you can't see me, I was talking with my mute on. My mouth was moving, but voice was not coming out. So we fixed that. Hey, Darius.
Maggie, it's great to see you. It's great to hear you as well, my friend.
Yeah, right. I know. We were working on your camera before you went on. It's just one of those weeks when you have for those of us sitting in the US, when you have a holiday weekend and you are off on Monday, it just feels like the whole week piles up into the 4 days that you have left. So it's been a marathon and it's only Wednesday, but on we go, upwards and onwards. So Darius, the Fed really is in focus today because we had the Fed minutes, but it's really been this story over the last couple of weeks once we started to get this hotter than expected data, the inflation surprises, and we've sort of seen this rethink in the markets. And the Fed confirming it seems like a lot of, what the conclusion the market had been coming to, and they themselves have been saying, right? They're not in a rush. In fact, they're concerned about going too early. Where do you think we are in this cycle? How long are they going to have to sit here?
Well, thanks again, Maggie, for having me on. It's always a pleasure to be with the Real Vision community. In terms of how long the Fed can be on hold, I mean, I think higher for longer is certainly something that's kind of been lost out of the market, a narrative, the lexicon, if you will, over the past couple of quarters. But in our opinion, it's due to come back and perhaps by the second half of the year, come back with a vengeance. One of the things we've been highlighting in our research of late here at 42 Macro is this market regime transition from Goldilocks to reflation. That's something that's occurred this week. And how we determine that, Maggie, is through the lens of our global macro risk matrix, which is the primary quantitative risk management system we use to help our buy-side clients consistently stay on the right side of market risk. So just really quick, just giving you guys a little background on that model. Brian, if you throw up slide number 1 in today's chart pack, where we show the 42 volatility adjusted momentum signals that are currently contributing to this newfound reflation regime. In terms of how this process works, we're scoring 42 of the most important asset markets in the world through the lens of our volatility, just a momentum signal. And then we're relating that information back to, we're telling that information in accordance to how each of those asset markets have traded historically in each of those regimes. And currently, if you throw slide 2 up, Brian, reflation now has the highest share of markets that are confirming it as the market regime. Therefore, we say this is the new market regime. This is what you should be doing from the perspective of your portfolio. You're actually already starting to see some of this. In terms of the key portfolio construction considerations in reflation, you tend to want to be long risk assets over defensive assets. Growth tends to outperform value. High beta tends to outperform low beta. You think about things like emerging markets, international, generally outperform developed market type exposures. Credit spread products tend to outperform G10 sovereign debt. Foreign currencies tend to outperform US dollars. So there's a whole host of market implications as a function of this, kind of subtle regime shift. It's still risk on, and we're expecting risk on market conditions to trend for a while. But that's not to say that we can't continue this correction to help investors get more appropriately positioned for reflation, because ultimately we do believe the thing that's driving reflation really may ultimately turn into inflation, which is the risk off version, which is above trend inflation, above trend nominal GDP.
Yeah, so that's really interesting. So I think that two really important points in there. One is that you can be in a risk on environment but still see pullbacks, because I think that's confusing to people, and it feels like there's so much to worry about that it feels odd to be thinking of for some people about risk on. And we should mention we've got Nvidia coming out after the close. That issue of, are we in a bubble? Are things overvalued in tech? Are we going to see a massive pullback because of that. That's one of the worries that's out there. So trying to put those things together, and we can talk about that. I think I also just heard you say this is the setup now, but it may change. We may be heading to something else too. That's different. So your time frame is going to matter, right? In terms of what you're favoring.
Yeah, 100%, Maggie, and very astute of you to latch on to those 2 points. I'll address them independently. So, in terms of can you see a correction? You very much can see a correction in the context of a risk-on market regime. That's something that happens. And corrections happen all the time in asset markets. We shouldn't lose sleep over them unless they're going to morph in a trending, change in factor leadership, which is what gets you blown up on the buy side and ultimately get you blown up even as a retail investor. So, I liken this period to today to the September and October period of 2020, when we had a 10% correction in the S&P 500. But underneath the surface, asset markets were actually getting more cyclical, more high beta, more reflation-y, and ultimately that was the precursor to the biggest reflation trade we've all seen in our lifetime. So I think this is very similar, particularly if Nvidia has some sloppy results or the market just reacts sloppy to whatever results they report. This is something that could obviously deepen the correction given the concentration we've seen across all these major U.S. equity market indices. But ultimately, in our opinion, we think that's a buy the dip for now. Addressing the second part of your question in terms of going back to the original question, how long is the Fed going to be on hold, higher for longer, all that kind of stuff. We've been talking about in our research for a while now. Our clients have benefited tremendously from the confluence of immaculate disinflation and our resilient U.S. economy theme that we authored back in the summer of 2022. Those two things have coalesced to form the Goldilocks market regime that we're just exiting from and profiting from. But we might have a quarter or two in reflation, but ultimately we think that the terminal destination for this pivot is to the inflation regime. Inflation is the risk-off version of reflation. It's above trend nominal GDP growth, or with the Fed taking away the punch bowl. Right now, the market is effectively saying the Fed's not going to take away the punch bowl, certainly not in any kind of material or draconian manner. And also, Treasury issuance policy continues to be quite favorable as well. But we're ultimately thinking that by the second half of the year, it'll be pretty clear that inflation is unlikely to return to the 2% target without, at the bare minimum, a higher for longer policy by the Fed and more tight fiscal policy by the Treasury.
Yeah, that's super important. So Andreas just dropped his latest report on the platform, and he's also talking about inflation, and he's worried about bonds in this environment. Let's listen to a clip from that, and then we'll talk on the other side.
When we look at interest rates, it gets a little bit more tricky. I have a chart on sort of a beta study between interest rates and the ISM manufacturing cycle. And if you look at 10-year interest rates in the US relative to ISM manufacturing, those two charts or lines, they were basically glued to each other from 2008 until 2020. And then inflation started wreaking havoc with this correlation. So inflation was back as a driver of trends in interest rate space. And given that we see this cyclical uptick now with some signs of already sort of accelerating underlying inflation pressures, I think the safest thing to say around interest rates here is that they probably lean upwards in such a scenario here. So I don't see much reason in buying 10-year treasuries as a diversifier in your portfolio here. I would rather look towards the commodity complex, stuff that actually performs in a scenario where manufacturing ticks up, inflation ticks up marginally, and liquidity performs in the dollar markets. I'll show you one chart on why that is. It's very hard to buy bonds in this scenario if wages reaccelerate, if the price of goods reaccelerate alongside the commodity cycle.
And that full interview is available on our website. If you're watching on YouTube or listening on the podcast and you are not a full member, come register at realvision.com so you can stay up to date on all the amazing things and conversations we have going on. So, Darius, Andre is saying hard to buy bonds in this environment and talking a lot about commodities. And we had Adam asking, I think you partly answered his question, which was after evaluating all the data, what's your current stance on the market? How are you positioned in the short term versus the medium term outlook? I think you just talked about short term versus medium term, but how are you thinking about this? Are you finding the bond outlook difficult as well?
Yeah, absolutely. So the bond outlook is quite interesting, and I want to go back to the discussion that Andreas just to sort of put in front of us, because I think it's a very important discussion to have, and it's certainly a discussion that I've had many dozens of times with our institutional investor clients across global Wall Street. I've had many conversations with some of the most important PMs and CIOs of the world about this very topic, about how these traditional models like DSGE models and autoregressive tools have really just failed investors and failed economists in this post-pandemic era of above trend nominal GDP growth and real, true fiscal monetary largesse. This has been the most unusual business cycle that we have on record. We don't have too many business cycles on record because we only really started tracking the business cycle roughly 100 years ago. But in terms of this is by far the weirdest one. We have a lot of asynchrony throughout the various cycles in the economy. We have something that's going on right now that we've never seen before, which is immaculate disinflation. It's obviously been a very powerful force for asset markets. So in terms of, I think we need to, as investors, have an open and honest debate about the tools and models and frameworks that we're using to generate investment insights and ultimately position for as investors. Brian, if you throw up slide 5 in our today's chart pack, we talked about this before, Maggie, in terms of our macro weather model. This is a dynamic stochastic system that we built in response to the recognition and the long form discussions that I've had with our institutional investor clients over the past couple of years. To better right size our portfolios to market risk. The reality is the economy is a lot less, again, as I mentioned, synchronous. The various cycles within the economy, whether they be real economy cycles on the left or financial economy cycles on the right, have broken down and have been less correlated with each other as they ever have been. And this is why we built the dynamic stochastic system to help us, sort of understand, okay, what's actually changing in the economy, as opposed to saying, oh, this thing changed, therefore that thing should change. That's what most investors are still doing. And in our opinion, I think that's going to continue to cause investors to lag broader market returns.
I think that's a really, really good point, Darius. And we've been talking a lot about this, and we're going to continue to talk about it next week in some interviews we're doing, because it's been confusing, right? But to your point, it's been very different. And what's driving it matters. I had a conversation with Paul Hodges today with another small group of our VIPs. And, he was sort of saying at some point, that would have been true if you're in a capitalist situation, but in many ways, because of all the government spending we've seen, we're not in that situation. So things are happening, but you can't apply the same cause and effect that you may have done in prior years or prior decades. And it was really fascinating. So you're right. It's so important, I think, to kind of reboot and look at that. And that's why we lean on folks like you who are kind of grinding it out down deep in the research and modeling to try to figure out what's accurate now and are we looking at the right things. So it's super important to flag that.
Yeah, I appreciate you saying that. And it's not like we have, some real clear crystal ball into the future that's clearer than it's certainly clearer than the average investor, but, not any more clear than our institutional investor clients. The reality is we just have the humility to understand and accept the fact that a lot of these traditional relationships, these two-factor models or these, even more complicated DSG autoregressive models just aren't working with the same precision and accuracy that they worked in the Great Moderation. And the reality is, unless we accept that and humble ourselves and accept the fact that markets and the economy are going to be a lot more dynamic and stochastic going forward as a function of this, in my opinion, the fourth turning regime that we're in, and as a function of that, the fiscal monetary largesse we're seeing in response to various cycles in the economy. If we accept that and humble ourselves and incorporate that humility into our investment process, I think we're going to have much better results than investors that are certainly relying on old tools, but certainly even if they're not relying on old tools, not having the humility to pivot to new ways of thinking, new ways of assessing economic and market risk.
Yeah. That's what we talk about all the time. We all have to sort of keep reskilling and stay on the learning journey because it's not a static environment and things are changing. So we've got a few questions here. Let me see. I want to get to a few of them because they're good. So the macro butler is asking, Darius, is the bubble not in the bond market rather than the equity market? I think a little English translation here, but are we seeing more of a bubble in bonds, even though everyone's been worried about the bubble in tech? I think that's what he's asking.
Yeah, no, you'd have to have significantly higher. So if you think about, how to deconstruct bond yields, you need, the trend nominal GDP trend and term premia. Term premia are right around flat right now. The mean of the term premia for the, at least if you look at the ACP model, which has a time series going back to late 1960s, the mean of that is around 150 basis points. So you can argue that just get back to mean term premium levels that, the 10-year treasury yield is perhaps undervalued by 150 basis points. But certainly, I would argue that relative to the Fed's neutral rate target of 50 real, 250 basis points nominal, that we are probably, the Fed is a little bit undervalued, and the markets are appropriately pricing that in. If you look at money market curves out 2-3 years, they're not getting back to 2.5%, a 50 basis point real. So I think the market is a lot more in line with where we've been, which is, this economy has sustainable juice. You remember that sheet I would come on with the 10 things that were contributing to our resilient U.S. economy theme, and a lot of those things are persistent, structurally persistent.
Yeah.
This cash on corporate and consumer balance sheets isn't going anywhere, Maggie. We have, I want to say it's about, roughly $5 trillion of cash on household balance sheets, $2 trillion of cash on corporate balance sheets. If you aggregate that, it's 6 and 2. So it's right around $8 trillion of cash on household and corporate balance sheets here in the U.S. combined. That's up from $4 trillion prior to the pandemic. That $8 trillion is 5% of total assets. We haven't seen such a high ratio of liquidity on household and corporate balance sheets in the U.S. economy since going back to the early 1950s. So we don't really know what to make or what to think about the resiliency and sustainability of this above trend nominal GDP environment that we're in. And so I think one thing that's happened in asset markets dating back to the beginning of this conversation with the subtle regime shift from Goldilocks to reflation, I think that's the market's interpretation of saying, hey, soft landing has peaked in terms of the market psychology, the probability associated with the soft landing, and is losing share, and no landing, that scenario is gaining ground as a function of that. And eventually the no landing will take too much share from soft landing and actually cause problems for asset markets, because market participants will appropriately forecast that the Fed and Treasury will start to take away the punch bowl. But in our opinion, we're not there yet, even though we may still be in a correction in equities.
So Doug is asking, if reflation is negative for DXY, do you expect commodities to outperform the market?
Yeah, absolutely. So commodities are one of the risk assets tend to outperform defensive assets. So commodities are certainly one of those plays that tend to work well in reflation. Not every reflation regime is going to look exactly like all the other reflation regimes in history, but what we're trying to do is create a central tendency of the distribution so that we know what kinds of factor bets and factor pivots we need to make to stay on the right side of market risk. When I say that phrase, that should trigger something in your head as particularly as a retail investor, because our buy side clients, the people I meet with, every afternoon, they need to stay on the right side of market risk. They don't have a choice, otherwise they're going to lose their seat. But a retail investor can, be long a theme or short a theme. They can be short a raging bull market or long an asset that's drawing down for multiple quarters at a time because they believe in the long term thesis. The reality is, that's how you blow yourself up. But the reality is there's no risk manager to tell a retail investor they need to stop doing that. But if you want to stop doing that and you want to actually start to consistently make and save money, you got to think about incorporating tools that will allow you to stay on the right side of market risk, like our global macro risk matrix. It's a trend following system that's obviously done quite well for our clients.
Yeah. So Adam was asking, in reflation, what does that mean in terms of allocation decisions? Are you favoring certain styles, sectors, geographic areas, underweight, actively short? I think that if I remember correctly, Darius, you're not a fan of shorting because of the dynamics of the market, right? Did you say that one time when we were on?
I don't believe any retail investor has any business shorting in the world. I don't think most RA investors have any business shorting. Leave the shorting to the market neutral players whose job it is to short. Shorting is too difficult to risk manage. I'm not saying that I'm not telling people what they should do. I'm just telling them if their goal is to actually make and save money across market cycles, the best bet is to approach investing from the perspective of one-sided distribution of risk and hedge the other side of the distribution with either trend following strategies or delta or option strategies that will allow you to take advantage of pullbacks in the markets that preserve capital and allow you to reinvest. That's the way markets go up over time. With the exception of currencies and commodities, which are stationary time series, the vast majority of asset markets appreciate over time. So the reality is there's really, you're really fighting a lot of data and a lot of return you put on short bets. And so, when we're coaching our institutional investor clients on these factor pivots like high beta long, low beta short, cyclical long, defensive short, those kinds of bets, EM versus DM, those kinds of bets you would make in reflation. Industrial commodities, energy commodities, those types of things are the kind of things you want to be long versus a US dollar or gold in that space. Those are the kinds of bets we're coaching our institutional investors to make. But as a retail RA investor, just go be long the thing that's working and make sure you have some systems in place or some hedging in place to take care of the leftovers.
Yeah.
Way better.
Again, super important, right? Know what kind of trader you are. The messaging is not the same depending on what your needs are. So if you are retail, you are going to be paying attention to things naturally that others are either not at liberty to, or they have different mandates that they're following. Got a question about Bitcoin from Ralph. I can see a bit of a shorter term pullback in Bitcoin and ETH. What does Darius think of those and the US dollar going forward?
Yeah, so reflation, Bitcoin is an asset that works very well in inflation. Again, reflation is a risk-on regime. The difference between reflation and Goldilocks is very subtle. You tend to want to be more exposed to sort of the cyclical components of asset markets. You want to be even less exposed to the defensive components of asset markets, things like gold, things like G10 sovereign debt, things like the US dollar relative to a Goldilocks regime. You don't want to be long those things relative to their counterparts anyway, but you want to get incrementally less long those things or incrementally short those things if it's your job, emphasis on job, to be short those kinds of things.
So Nvidia is just crossing
Ooh, let's check that
now.
out.
Yeah. And so I think, you always have to see, and a lot of this is in the conference call, but they beat, but the bar was so high. We were talking to Tony Greer yesterday. They look like they're down a little bit after that 3%, now 1%. I think a lot is going to depend on what they hear in the conference call. But, if you're beating by 2 billion projected revenue and you're Nvidia, would that be good for anybody else? Yes, but what does that mean? And then, what does all the positioning around that mean? So there's a lot that goes into this. So this is when you have the opportunity to sit back and maybe watch some of it until we get some clarity on
Yeah.
what this is going to mean. But it does seem like this is a big, at least sentiment bellwether, Darius.
It should be, and one of the things, though, going back to the beginning of this month, our positioning model, which tracks a variety of different indicators across the asset classes to identify, potential pain trades in asset markets. And one of the things we were flagging at the beginning of this month was a high degree of risk of a pain trade in equities, a pain trade lower in equities, because sentiment, if you look at retail investor sentiment, had gotten too extreme. If you look at systematic investor positioning, had gotten too extreme, at least according to our model. If you look at the gross exposure to equities, for market neutral players, that had gotten too extreme, at least according to our model. So in our opinion, we were flagging the elevated risk of a market correction, of a pain trade lower in stocks. Nvidia just beat revenue by 8%, and the stock is down. So that tells you that the positioning, at least associated with this particular name, and really, obviously it's a bellwether for the broader market, was very extended and stretched. And this is why corrections happen. Corrections happen because of basic supply and demand reasons. They don't necessarily mean that the fundamental outlook has changed or that the tech bubble is about to come unglued and unwound. I highly doubt it's about to come unglued and unwound. Certainly not if this reflation regime remains persistent for at least another quarter or two, as we suspect it is.
So when we're looking at the rest of the world and we're trying to plug in what's happening with growth, so do you see if we go from a reflation, which is kind of Goldilocks, to an inflationary regime, if that's where we're headed, are we seeing strong growth leading that, or is it one of those stagflation type stories where we have the worst scenario where we see growth slowing but inflation remaining persistent?
Yeah, absolutely. So I'll answer that question really easily. Brian, if you go back up slide 2 on this chart, where we show the sum and share confirming markets, again, what we're doing is tallying all the volatility adjusted momentum signals across the 4 grid regimes and how they've historically traded on the asset markets to effectively now cast the market regime so that we can respond in our portfolios to make those pivots and factor bet changes and asset allocation changes in real time when it's time to go, as opposed to after the fact, once the markets move. But going back to answer your specific question, Maggie, inflation is a risk-off regime. So they're effectively thinking about the same fundamental dynamics. Just one is without policy restraint on the horizon, and one is with policy restraint on the horizon. When you're in a reflation regime, that means the collective wisdom of all the investors in the world, particularly the institutional investors in the world, because that's the kind of markets that we feature on that table on slide 1, Brian. The institutional investors in the world are expecting either accelerating nominal growth or above trend nominal growth in a reflation regime or inflation regime. The difference, as I mentioned, is in reflation, the risk-on version of that, the market participants are not expecting a taking away of the punch bowl, if you will. But in the inflation version of that, they are expecting the fiscal monetary policymakers to take away the punch bowl. And that's exactly what we saw throughout 2022, as you see in the chart on the right on slide 2, where inflation was a top-down market regime for pretty much all of 2022 into kind of early November of that year. So in our opinion, that's probably back on the horizon in our opinion, because we certainly believe that in terms of the soft landing scenario, losing share over the next couple of quarters, we think that share is going to go to the no landing scenario as opposed to the hard landing scenario. We think that scenario is toast. We think it's more likely that the economy continues to hang in there, continues to show the resiliency that we called for and often back in the summer of 2022.
Interesting. What about China? Can it lift itself out of its malaise?
Absolutely not, but it's going to continue lifting asset markets. That's not to get too I don't want to tip my own cap too much, because we let our clients do that for us here at 42 Macro, but that's one of the calls that we've gotten right as well in recent months. And then go back to mid-December, we were explicitly calling for front-loaded policy support out of Beijing to start calendar 2024, and that's exactly what we're seeing. If you throw the slide 7 up, Brian, the slide 7 just shows the various means and metrics that the PBOC uses to influence monetary policy and financial conditions in the Chinese economy. Its balance sheet is ripping. If you look at claims on banks, which is effectively the medium-term lending program or the open market operations program, that's ripping as well. If you look at, they're obviously lowering triple R rates, their reserve requirement ratios, they're lowering the loan prime rate, they're lowering their medium-term lending facility rates. They've pledged more supplemental lending to specific sectors of the economy. So they're in like a full-fledged, reflation style policy mix here. They're implementing that. But the reality is, it's not going to do anything to sustainably resuscitate the Chinese economy. What it's actually doing is on slide 8, which is something we called for explicitly, which is the panic that we continue to see out of Beijing to the bare minimum shore of confidence in the nation's equity market. We saw some maneuvers there this morning from a regulatory perspective. The panic that they continue to exude has been very favorable and very positive for the positive global liquidity impulse that our macro weather model, going back to that dynamic stochastic system we built, flagged in real time in November as contributing to Goldilocks market conditions. So, again, this is, if you hear one thing from us in our process, it should be humility and accepting the fact that a lot of these things just happen and we don't need to predict them all. We can build two systems and tools and have a robust enough fundamental research process in place, as we do here at 42 Macro, to actually catch these things in real time when they inflect. So again, that we can make the appropriate pivots in our portfolios to stay on the right side of market risk. If you don't want to stay on the right side of market risk, if you just want to be long or short your theme and stay long and short your theme no matter what's happening in the market, I have no idea where you're wasting time watching programs like this, but God help you.
Yeah. Nobody wants to lose money, Darius. I think we can all agree on that.
No, I disagree, but I respectfully disagree. I think there are people who truly believe in a theme and an investment, Bitcoin, for instance, Nvidia, for instance, and that will ride it down no matter what because they believe in the long-term outlook. And there are investors that treat their entire portfolios like that on the retail investment side. Obviously, you can't do that if you're a professional investor.
Right. Well, and to be fair, Raul sometimes talks about the fact that he lives very much in the future. And so there's a portion of what he does that is like super, super long term, and he's comfortable with that. But I think for a lot of people who are listening, and increasingly as we all face funding ourselves longer in this journey, we really want to try to avoid the drawdowns if we can, because it's painful and it's hard to make them up. So I think that, anything we can do to help people in that regard is fantastic. So we appreciate it. I got to tell you this one comment. It's so great. Let me find it. It's from Bernardo. Darius, where do you buy your clothes? I wish I could be half as dapper as you.
Well, obviously, I got a guy.
I got a guy. Of course, Darius has a guy.
You need a guy. I'm six. So normal people, in normal people terms, I'm 6'4", 285 pounds.
Yeah.
To the
you
NFL,
buy that off the rack, baby.
Yeah, I was 6'3" when they measured me, but I'm 6'4" in normal people terms and 285.
For those of you who listen often, I have a young football player in my life, in my house, and buying him clothes is difficult right now. We got some big guns on his. I can't fit him in a lot of stuff. So I might need that guy, Darius.
It only gets more difficult, Maggie.
I love it. Well, hopefully looking at the markets wasn't as difficult thanks to you today, Darius. So we appreciate it. Thank you so much.
Maggie, it is always a pleasure to be here with your guys' community. You guys have phenomenal questions. You're obviously a fantastic host, and I just want to say thank you. You guys are doing a great service for the world. Hopefully, I think we're doing a great service for the investors that subscribe to our product as well. But at the end of the day, what we're really just trying to do is educate and help us all, achieve better financial outcomes for our families and our clients. And I'm proud to say that you guys are doing that, and we're doing that.
Absolutely, and we're going to be doing that all this month. We're doing a series coming up. Don't F this up.
Is that the name of the series?
Raul. Yes. Well, it's more than that, but
you were
threatening to make an NFT if I keep saying it. So well, we'll find out more. We'll toss more breadcrumbs, and we're going to be diving into how important it is to have a framework as well next week. So we'll do all that. And this week, crypto gathering, folks, tomorrow and Friday, it is free. 22nd, 23rd. All you have to do is go to realvision.com/crypto gathering and sign up and register, and then you get access to the event. While we were all worrying about our portfolios, there have been billions flooding into those Bitcoin ETFs. So we've been getting a lot of questions from all of you about what it means and this sort of intersection of this now with macro. So we're going to dive into all of that over the next 2 days as a way to continue to educate and help. So be sure to sign up for that. Thank you, Darius. We'll catch up with everybody tomorrow. Take care and good luck out there.
Thank you, guys.
Please don't fuck this up. When we've got such a massive opportunity in crypto, we become our own worst enemies. When the bull market truly starts, you end up losing your minds, doing all the wrong things, and end up poorer than when you started, or just not capturing it. Anyway, I'm serious about trying to help you not fuck this up. And the crypto gathering is all about that. 2 amazing, fun-filled days of learning about how to get this right. That's on February the 22nd, 23rd. And there'll be panels, Q&As, interviews. Come and join us. It's free. Register at realvision.com/crypto gathering. That's realvision.com/crypto gathering. And come and help yourself not fuck this up. I'll see you there.
Join over 5,000 attendees for the largest AI event in Asia at Super AI Singapore, June 5th and 6th, 2024. Raoul Pal, Benedict Evans, Balaji Srinivasan, Edward Snowden, and over 150 others will join the industry's most influential to explore and unveil the next wave of transformative AI technologies. Singapore will become a vibrant AI hub for a week from June 3rd through June 9th, with over 150 side events that will make for unparalleled networking opportunities. Visit www.realvision.com/superai for 20% off tickets with the code REALVISION or click below.